After reporting their earnings, Lam Research, one of my favorite tech companies, is up by 7.5%, and they actually beat their earnings per share by 3 cents and beat their revenue by 70 million, and well, the market seemed to like that. Now, as I always like to be transparent on this channel, I actually own shares of this company in my portfolio. I started buying them when they were trading at about $80 a share, and I kept buying as they were falling lower, decreasing my basis cost. Now we can actually jump to my portfolio and you can see that currently I own about 9 shares of the company. It makes up 6.71% of my portfolio, and after yesterday I am up by 4.38%. But what we want to figure out in this video is if after their big jump they are still trading below their intrinsic value. And to do this, as always, we'll jump over to my stock valuation spreadsheet where we will plug in the company's ticker, and all the metrics will show up automatically. And as always, if you want to download these spreadsheets for your own personal use, you can do so at the link in the description. It's a great tool for beginner and advanced investors. Now, the first thing we can see is the company's dividend yield, which seems to be sitting quite low at only 1.14%. But if I zoom into pillar 8, their 5-year dividend growth is sitting at 13.37%, which is 3 times as much as the average stock year-over-year dividend growth. I mean, they grew their dividends from 46 cents in 2020 to 80 cents in 2024. That's a 90% increase. And something I love even more about the company is their low free cash flow payout ratio, which over the past 5 years has been sitting at 24.24%, and currently in 2024 it was sitting at 23.94%, which leaves them a lot of free cash flow to direct into innovation, which, as I always say, is especially important for companies that operate in the technology sector, which have to direct a lot of their free cash flow into innovation to stay relevant. And with their very low payout ratio, they still have enough free cash flow to direct into raising their dividends even more, buying back shares and paying down debt. So I'm in love with the company's low free cash flow payout ratio. But let's also jump to the 9-pillar analysis, and here we can see that the company gets a rating of 9 out of 9 with all the pillars in the green. So first let's have a look at their 5-year PE ratio and their 5-year price to free cash flow, which are sitting at 18 and 19. But if I zoom into pillar 1, currently the P ratio is sitting at 24.54, which is higher than the 5-year average and higher than the average stock PE ratio, and shows me that investors are valuing Lam Research at a premium. And that is actually the same case with the price to free cash flow, which is currently sitting even higher at 25, higher than the 5-year average and higher than the average stock price to free cash flow. Now let me explain to you why I believe that a company should be valued at a premium. Lam Research, alongside with Applied Materials, are the 2 largest companies that create and service semiconductor processing equipment right after ASML, which by the way isn't a US company. So with the increase in tariffs, I truly believe that Lam will start getting more and more customers, raising their financials and their stock price. So I do believe that the company should be trading at a slight premium, which I actually bought it at. But now let's have a look at their growth. Their 5-year revenue CAGR is sitting at 11.77%, free cash flow at 30.35%, and their net income at 17.27%. Now, something great about this is that the company's free cash flow and net income are growing faster than their revenue, which is something I very much like. If I jump to pillar 3, their revenue grew from 10 billion to 15 billion in 2024, but their net income grew from 2.2 billion in 2020 to 3.8 billion, and their free cash flow grew from about 2 billion to 4.2 billion. So their free cash flow increased by more than 100% in the past 5 years, and I am in love with that, as the free cash flow is the blood of the company. It is used for everything, as I already mentioned, from share buybacks to mergers and acquisitions. But now, jumping back to the 9 pillars, let's have a look at some of the remaining metrics. And first, let's have a look at the decreasing shares outstanding. Lam Research has been decreasing their shares outstanding at a very high rate of 2.63% every single year, and this is great for 2 reasons. The first reason is that they pay less free cash flow out in dividends by 2.63% specifically every single year, and the second is that the value of your shares increases by 2.63% every single year. Now, the second thing I like about Lam Research is that their 5-year profit margin is sitting nice and high at 25.49%. A high profit margin is something I always like to see, as it means that the business, well, is very profitable. And finally, the company doesn't have almost any debt. Their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.45, which means that with the current dividends they are paying out and with the current free cash flow they are generating, it would take them only about 2 years to pay off their $5.68 billion in long-term liabilities. So now that we have gone through the 9-pillar analysis and everything is looking nice and sweet, let's calculate the company's intrinsic value. So first, jumping to the Graham's formula revised, we have to predict the company's 5-year earnings per share growth. Now we can do that by going back to the 4th pillar, where we can see that the net income has historically been growing at a rate of 17.27% yearly. We can also jump back to Seeking Alpha, move to earnings and have a look at the earnings estimates predicted by analysts, where we can see that in 2025 the EPS is expected to grow by 23%, then by 6.19%, 19.54%, 7, 8, etc. So based on this and the research I did in the backend, I will predict the high earnings per share growth at 16%, medium at 12% and low at 9%. And when I combine this with the analyst predictions, we will get the 5-year earnings growth estimate at 14.10%. I will then combine that with the 5-year EPS, base PE, growth rate multiplier, average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and get an intrinsic value of $101.19, which is 20% higher than the current trading price. Now for the second valuation model, the discounted cash flow model, we will have a look at the free cash flow of the company. So we will plug in the free cash flow over the past 5 years and calculate the average growth rate at 30.35%. Now, as we are predicting into the long term, into the next 8 years plus, I will predict the growth a little lower. So the high growth I will predict at 13%, medium at 11, and low I will go with 9 again, and this will give us a growth rate of 11% into the future. And by doing this, we will calculate the future free cash flow. Now to calculate the present value of that future free cash flow, we have to plug in a discount rate, which I plugged in at 9.1% based on the WACC of the company. I will then sum up the present value of all of that future free cash flow, add cash and cash equivalents, subtract total debt, and get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $103.29. Now for the third valuation model, I will compare Lam Research to ASML and Applied Materials, which I already mentioned in the video. I will take these companies' current stock prices, divide by their earnings per share, and get their PE ratios, which I will average out and multiply by the earnings per share of Lam Research to get an intrinsic value of $95.37. And for the final valuation model, we will look to the dividend discount model. I will plug in the dividend growth over the past 5 years and calculate the average to be sitting at 14.84%. Now into the future, as I do like to be a little more conservative, I will plug in the high growth at 15%, medium at 14%, and low I will go with 10%, and that will give me a projected growth rate of 13%. But as the discount rate is lower than the projected growth rate, the intrinsic value comes out negative due to the mathematics within the model. And for situations like this, we have the alternative model where the intrinsic value will come out at $105.34. And now when we average out the 4 valuation models, we will get an intrinsic value of $101.30, which is 25.5% higher than the current trading price of $80.73. And with a margin of safety of 10%, we would get an acceptable buy price at $91.17.